Hello everyone. Now, today we are going to discuss rather kind of obvious but I would say neglected topic in trading, and it is importance of pips in trading. Like everyone knows, at least everyone who has even the slightest relation to trading and forex trading, that pip is percentage in point in foreign currency. For instance, this is that minimal movement in euro against dollar pair. For instance, we could have 1.11 euro. A euro could be priced 1 point, no, precisely. Dollar could be priced as 1.11 against euro, and it could fall to 1.085. And this movement is expressed in pips. Like let's open my self-made pip calculator, and we could see that this is 260 pips, or fall from 1.11 to 1.84 is 260 pips, which is also confirmed by Wikipedia, which is saying that in foreign exchange markets, pip is a unit of change in a exchange rate of a currency pair, and you could calculate them into 1,000 pip calculators, which you could find across internet. So as well, you could learn everything about pips in free information which you could find on Google. So I wouldn't do that. I wouldn't go and over restate everything that is written for free. What I will do here is talk about importance of pips when we are measuring trading performance. Now, in this way, we would see whether it's objective measurement or not, because let me give us that example in foreign exchange, where we see that in the last couple of days, euro moved from 1.11 till 1.84 against dollar. So it was falling for 260 pips. But what does that mean? Realistically, that means that we are going to short euro. For instance, we could have $5,000 and we could use 100,000 euros, which could be standard lot. And if we would do that, we would make 52%, because 260 pips would be $2,600. So that is that, right? But if it's objective measurement, well, ask yourself. There are questions which are important whether we should evaluate this performance. For instance, if you are truly using that leverage with $5,000, because this is rather small movement for foreign exchange. Like if we see weekly chart, it actually means nothing. This is like average volatility in foreign exchange, which we could expect every other week. So whether we will be using that kind of leverage with this kind of capital, I would say it would be way too risky, because if the deal will go the other way, we would have to make some stop loss, and that stop loss would probably be at the similar levels, so that we could cancel out volatility. And that means consequently the loss will be like as large as this profit, and which will yield like 50%. But no one in the sane mind will take this kind of loss if they want to trade consistently. So that's the thing. And point of what I'm trying to say here is that you could have trade which yields you 260 pips of profit, but true question is, how did these pips will translate to real dollar and percentage incomes relation to your capital? Because I could also trade 10 lots with $5,000, and now we will have like 5 times return on that small trade. Or we could trade one mini lot, which is 10,000 units, and then we will have 5% return. So that's the question. How much leverage we use? And then we would see how much we will make in euro or dollar terms and in percentage terms. Because PIP itself, it's only one measurement. The key in successful trading is to evaluate how does that in turns first and foremost in percentage returns, and then in dollar returns, because dollar returns are only for our gratification, but real deal is to see how we are making and losing money in percentage wise relative to our capital. Because 5% might be small, might be a large percent, because if you're making two 5% deals in a day, that's absurdly large returns, and you will probably be billionaire in the next couple of years. But if it's 5% per year, you might ask yourself whether there will be better ways how to invest in markets. So there is that. And what I'm saying here now, yes, this is the important lesson of pips. Understand whether trades have mathematical sense or expectancy. You could see that into pip value. Like here we saw that one short trade which made money from 111 to 1.84, that made money. That's positive in pips. Also, we could make money from 122.88 till 1.06, excuse me, 0.964 euros against dollar. That's good trade in pip value. But only if we establish that base, then we could see how that proportion will make returns on our capital. Then we have to express that into percentage and leverage terms. And this is real trading. This is how real trading works, to understand those probabilities, those risk reward returns. So we could see that this pip return gives us maximal, most efficient capital return depending on our risk premises. And there is actually not one definitive answer which would state us that whether we should make 5% return, maybe 10% return, maybe maybe 15% return. Like who is to say that we should use 1 mini lot, 2 mini lots, 3 mini lots, or one standard lot? Who could say which is the best way, which is the best risk? Well, this is only could be seen into context of your own individual strategy and risks you are willing to put in your strategy. So we have one pip difference, and we would have almost infinite variety of returns out of that one pip returns. If you understand that shift of how we perceive trading, then you have something like, because this is what the scammers are selling, that I'm giving you 500 per week pip returns. But what the hell does it mean? It could mean completely different thing if you have like $100 or $100,000, because your leverage would change proportionately. It could say nothing to you. If some, that's why they are avoiding those hard questions, those questions which would answer what is the real relation to your trading capital with those pips, what's the best risk management tools to maximize those pips values. If those guys would starting to say these kinds of things, they will be onto something. But other than that, if someone says you simply that he has strategy that could make 500 pips per week, that probably implies that they are using standard lots. But standard lots for trading accounts below $50,000 is quite reckless and dangerous. So no one could tell, no one probably remembered for you to tell that. But that's misleading and beneficial only for those who are selling you these fake products. So that's the thing. And probably if you are not my student or my client already, I have to give a couple of other videos which explain to you how real probabilities and risks works in trading. But if you want to accelerate this process, I have courses which could show you how you could change that mentality and see how professionals think in these probabilities. That the leverage and use of leverage and use on risk rewards is the thing that makes money out of these pips, not the pips themselves. That's the real thing. And if you like this video, of course, what you should know what you should do. You should follow me and become my client. So stay tuned. Wait for my next video. Bye.